Have you heard of index annuities, but you have no clue what they are or even how they work? Or maybe you heard some negative things about them that completely turns you off regarding some of the fees it may have, or just the overall lack of control of your money. If that's you, you're not alone. Annuities are one of the most misunderstood financial products in the entire industry. So I'm glad you're here because in this video, I'm gonna give you complete clarity. I'll be going over the pros, the cons, the ins and outs. You know exactly what an annuity is, how it works, but more importantly, you'll be able to decide if it's something you want to use for your financial future or not. And the reason it's so important to understand how annuities work is because the vast majority of the time, you'll be dealing with retirement money from an old employer. And a lot of people are in that scenario where they left their job for whatever reason. Now they have to figure out, what do I do with this old retirement money in this old account that's just sitting there? Also, in the back of your mind, you know you don't plan on working for another 20, 30 years, so you have to be really careful with what you do with this money because you have to protect it. You want it to grow, but you also can't lose it. So it's critical that you become properly informed on this topic. So with that being said, let's get you educated. To make things simple, an index annuity is a saving option for either cash or retirement money, meaning you could take money out the bank account and put it inside the annuity, or it could come from a current or old retirement plan. But regardless of wherever the money comes from, you'll still receive the same benefits. And even though annuities can hold both cash and retirement funds, they're not offered by banks or brokerage accounts. They're offered by insurance companies and they're regulated on a state level. So every state is different, so not all states have all the same features. So if you speak to an agent regarding an annuity, make sure they're licensed in the state you're in because you want the information they're giving you to be valid to you and your current situation. So now that we have some of the logistics out the way, let's go over some of the benefits and the features. The first thing I want to cover is how does it grow and how does it earn interest? So when it comes to the growth, you're going to have a few different options. So one is the standard cap and the floor. So your money's not in the market, but it's going to follow whatever the market does based on this floor and this cap. So for instance, let's say your strategy has a 10% cap and a 0% floor. That means the most you can get in a given year or strategy term is 10%. But at the same time, the worst case scenario is that 0% floor. So in this example, let's say the market did 6%, meaning it's following the market grew and it grew at 6%. That means your credit to your index account would be 6% as well. Now let's say the market grew 10%, then your credit would be 10% because that's the cap. Now let's say the market grew 15%. That's where the cap comes in because you can't grow beyond the cap. So you would actually still earn only the 10%. So that's how the cap side works. So it's going to follow the market up until the cap. Everything above the cap, you do not get. It does not exist. So it's very important. You're always going to be limited to the cap. Now on the flip side, there's also the floor, and the floor is 0%. So let's say the market does 0%. Obviously, you're going to get 0% that year. Now, let's say the market crashed that year and went -10. You're going to earn 0%. You're not going to lose anything. You're going to stay exactly where you left off because 0 is the hero. You do not go below 0. Anytime the market's negative, you will get 0. No growth, but no losses either. Now, let's say the market dropped dramatically at 40%. Now, guess what happens in this situation? You're still going to get 0%. So that's where the cap and the floor comes in. So when it grows, you'll get that growth up until that cap. But if the market were to crash, you're always going to be protected. You're not going to lose money. You're going to be stuck at 0%. And it's important to know that all these gains, as you start earning interest every single year, all those gains are locked in. So if you had $100,000 in your retirement account and it grew to $120,000, that $120,000 is your new watermark. So you're never going to go below $120,000 moving forward. So it's just going to take from that point and keep stacking on top of that. So it's like a staircase. It's either going to go up or it's going to stay the same. So that's how the floor and the caps work. Now, the second way your money can grow are based on participation rates. So what participation rates are, they're allowing you to participate in a certain percentage of what the market does. So in this example, it's going to be a 200% participation with a 0% floor. So that floor means you don't lose money. So let's say the same scenario happens and the market did 6%. You would take that 6%, multiply it times 200%, which is doubling it. So you would actually earn 12% interest towards your account that year. Now, if the market did 10%, 200% of that is 20%. So you'd earn 20% credits towards your account that year. And if it did 15%, then you actually earn 30%. So you can see a 200% participation is just doubling whatever the market grew at. Now, the same thing applies from the previous example when it comes to the floor. So if the market does 0, you get 0. Market did -10, you get 0. Market did -40, you're also going to be at 0. So you're never going to take a loss. But this situation, you have no caps on your growth. Your growth is uncapped, and you're going to get 200% of whatever the market does. Now, I want to show you another example of how participation rates work as well. So let's say you're getting 50% participation. Now, in this scenario, you're only going to get 50% of whatever the market produces. So if the market does 6, you're only going to earn 3% interest for your account that year. If the market does 10, you'd earn 5. Market does 15, you'd earn 7.5. So you'll have to take whatever the market does and cut it in half because you're only going to get 50%, which is half of whatever the market does. In the same scenario with the 0% floor, 0 gets you 0, -10 gets you 0, -40 gets you 0. So strategies can be uncapped with a participation rate that's 100%, 50%, 200%. But now you know whether it's below 100 or above 100, you just multiply that times whatever the market did, and that's what you're going to earn towards your account that particular year. And then the third way your interest can grow is based on a spread. So what a spread does is the company is going to take the first some odd percent, and you can have anything that's beyond that. In this example, the spread is going to be 7%. That means the company is going to take the first 7%, and you can have whatever happens after that. So if the market did 10%, then they're going to take the first 7 and give you the remaining. So you would actually earn 3% interest for that particular year because they earned 10% in the market. They took 7 as a spread. So that comes out off top no matter what. And you get the remaining, which is at 3%. So if the market did 15%, they take that 7% spread, you earn 8%. If the market did 30%, they take their 7% spread, you earn 23%. So that's how a spread works. They're going to take that dollar amount or that interest amount off the top, and you can earn and have whatever is beyond that point. Now, here's where spreads can be a little tricky. So let's say the market did 7%. So if the market did 7% and the spread is 7%, that means they're taking that first 7%. So you would actually earn 0% credit towards your account that year. So it's important to understand that because if the market performs 7% every year for the next 30 years, you would earn 0% interest for 30 years straight. So you got to keep an eye when you're using an actual spread. Because if the market did -10, you get 0. Market did -40, you get 0. So those aren't a big deal. It becomes a big deal when the market is positive, but is not enough growth to overcome the spread. So those are kind of the 3 main ones that you'll see inside the index annuities. And you could choose between one or the other. And typically you can spread them out 33%, 33%, 34%, however you want to do it. But those are the ones you want to get comfortable with knowing when it comes to allocating your funds. Now, the next benefit is typically people's favorite benefit. And that's the fact that the product has no fees at all. So you're not going to be charged a 1%, 2%, 3% fee every single year. You put the money in, worst case scenario, it stays the same, but you're never going to get hit with a fee. Now, there are different strategies, like let's say there's a strategy where you could pay a 1% for an extra participation rate, or maybe you're paying for a rider. That's optional, but the base product has no fees whatsoever. Now, another unique benefit is that regardless of if the money's coming from a retirement account or cash out of your bank, you're going to get tax-deferred growth. So as your money starts to grow every single year and earn compound interest, so where interest earns interest and that interest earns interest, you don't have to pay taxes on that money every single year. So it's not like where you get the growth and you have to pay tax on the growth, and then you grow, then pay taxes, grow. You're going to constantly have tax-deferred growth compounding nonstop for you. So if you're looking to park money somewhere where it can just grow tax-deferred, an annuity can be a great place for you, especially if it's non-retirement money. Because typically retirement money grows tax-deferred, but when you have cash and you can have that grow tax-deferred, that's a huge bonus. Another benefit to having an annuity is that it actually comes with a death benefit. So it turns your cash into a death benefit, means it can bypass probate. So if you don't want your money stuck in probate, an annuity can be a great option for you when it comes to transferring your wealth. Another benefit is that they can hold almost any type of retirement plan. So whether it's a 403b, an IRA, even a Roth IRA, you can park all of those inside of an annuity. So you don't have to lose your IRA. You can take your IRA, put it inside an annuity, and have all those benefits that I mentioned previously. So one of the most common strategies I see is taking an old 401k plan, transferring it to an IRA inside of an annuity. So it stays tax deferred, but then it goes inside the annuity where it has all that protection. Now, when it comes to retirement funds, the most money you'll make is the money you do not lose. You want to avoid losing money at all costs because you don't have 10, 15, 20 years to make up for any losses. So you have retirement money, you need to preserve it, and that's why annuities can be a great, attractive vehicle for you. So the last benefit I'll cover when it comes to index annuities is that you have two options. You have an accumulation option and you have an income option. The accumulation means you're going to put the money inside the annuity and you just want it to grow as fast as possible, period, point blank. And on the other side, you have the income annuity where you put the money in and the goal is to turn that into a stream of income that will last you for the rest of your life. So it's almost like creating your own self-pension. So remember, one is focused on pure growth. It's going to grow as fast as possible. And the income side may not grow as fast, but that money will last you for the rest of your life and it will never run out. So based on your scenario, you can pretty much figure out which one is more important to you. Now, when it comes to disadvantages of annuities, the first one I would say is you don't have 100% liquidity. Now, annuities come with what's called a surrender period, meaning in the first 1 to 7 years or 1 to 9 years, you don't have access to 100% of your money. So you definitely want to have your agent show you what the surrender schedule is so you can see how much money you can tap into. Because most of the time, annuities company give you access to 10% without any penalties or any fees every single year. But you want to know your schedule every single year in case you do need to tap into your money. Now, the second disadvantage is that you don't get 100% market participation. Meaning if the market were to grow 40%, you're not going to get 40%. You're either subject to a participation rate or subject to a cap. But it's important to know it is a disadvantage that you don't get all the gains of the market. Of course, it does come with the floor protection, meaning you're not going to lose if the market were to crash. But this section is more about disadvantages. And the disadvantage is that you don't get all the growth of the market, period, point blank. The next one isn't necessarily a disadvantage, but more of a misconception. So an annuity does not remove taxes from your current plan. So if you have a 401k plan and it's tax deferred and you haven't paid tax on that money, just because you move it to an annuity doesn't mean you automatically no longer have to pay the taxes. The same tax schedule is inside the annuity that was outside the annuity. So it doesn't change your tax status. The only thing it will change is that money can grow tax deferred if it wasn't already growing tax deferred. But if you're going to owe taxes on the back end, that is not going to change because you put it inside of an annuity. And the last disadvantage is that annuities are not the best option when it comes to short-term goals. Meaning if you have $100,000 and you plan on putting $100,000 as a down payment on a house in 6 months, you probably don't want to put it inside of an annuity. You probably want to put it somewhere else. But short-term, immediate short-term goals, you probably don't want to put money inside of annuities. But if it's a little longer and you can, stretch it out a little longer, you don't need immediate access to it, then yes, put it inside of annuity. But I always say, look at the illustration so you can see what's accessible to you to help you decide if it's something you want to put your money in or not. So as you can see, annuities have both advantages and disadvantages, just like every other financial vehicle. So you're gonna have to assess your goals to see if it makes sense for you. And if you feel like you need direct help or you want to see illustrations or examples, feel free to reach out to our team. I'll put the link in the description box below. Click it, set your meeting, and we'll take it from there. So I hope this video helped. And like always, put a happy face in the comment section if you received any value at all. Don't forget to subscribe and share, and I will see you in the next video.